Hey, how's it going, everyone? So today I want to share with you guys why I'm still investing even when the market is still currently going down. Now that can be a scary thing for a lot of people, but I thought if I shared my journey and how I'm still investing even when the market is consistently going down, this might help you. No matter what is going on in the world, whether this is a video you're watching 5 years from now and the market's going down or 20 years from now and the market's going down, I think these principles are still going to be very true throughout the process and why it's a good idea to still be investing during a downturn. And by the way, if you are new here, my name is Dennis and I love talking about apps and services that really help you build wealth over time. So I want to share with you guys currently my M1 Finance portfolio, which is where I'm actually investing a majority of my extra income aside from my retirement. So what we're going to do is jump onto the portfolio here in just a moment. But of course, talking a little bit about why investing at a downturn in the market is always a good idea. Because if you're investing for the long term, it's not going to matter when you're putting your money in. Obviously, it's ideal to get your money put into the market when it's at the very bottom, but we never know when that's the case. So, they always talk about catching the falling knife when the market's going down, because you can be hurting yourself if you buy tomorrow, but then the next day after that, all of a sudden the market goes down another 5-10%. So what's the best thing to do? Well, there's a thing called dollar cost averaging. Now, what dollar cost averages is essentially where if you have a stock at a certain price point that is lower than what your initial cost is, buying more into it actually is lowering down your overall cost for that fund. And I'm gonna show you guys here exactly what I mean in my portfolio. Now, I usually share how much I'm making in dividends every month because that's kind of my main focus with my portfolio, but I'm also gonna kind of go into some other details here as well. So let's hop onto the screen here and you're gonna see my current portfolio, which is called Dividend Dennis, currently has $1,896.48. So you can see it's significantly down for the all-time, which is about $477 down. Now, the interesting thing is I've actually been putting a lot more money over the last month and some change based off of current events right now. And that is really going to show that I'm actually doubling and sometimes tripling down what I'm normally investing in, because I know that this is an opportunity for me to buy more and lower my actual dollar cost average. So I'm gonna go ahead and show you what I mean by this. What we're gonna do is look at my overall portfolio, and we're gonna go into the very first one here, which is the Vanguard Fund. So this is my overall investing. I have a couple different sectors. First is my Vanguard Fund, which is kind of like a universal ETF for me. It follows the S&P 500. Then I got tech, retail, consumer products, real estate, health, industries, and also financials. So that's really cool for me to be able to separate everything. But what we're gonna do is go into our slices category right over here for the Vanguard. So going into here, what you're gonna see is that right now I have 2.30 shares into this fund. Now, M1 Finance allows me to do fractional shares, which is really awesome. It means I don't have to put the full dollar amount to buy into this actual company or ETF in this case. So you can see here where it says average share price is $257.04. So that's on average how much I actually will be buying a share for. And then my total cost is $592.10. So you can see right over here that the market is actually currently trading this at $204.27. So every time I'm buying more into the market right now, even in fractional pieces, I'm actually lowering my average share price, because as of right now, with the 2.3 shares I have, that was averaging $257 versus where the market is actually standing. So obviously if I could buy into the actual share at a full total share, which is $204, that will lower my average significantly. But buying into smaller fractional pieces will still have an effect on that average dollar over time. So for me, buying more into the market right now is pretty advantageous because I'm buying at less, even though I still believe in either these funds or this ETF entirely. So I can do this with individual stocks as well. So if I go in here and let's say I look into my tech category here. So for example, we got Microsoft over here. It's my number one in this sector here. So if I go in here, you can see that I have a total of 0.879 shares. So I don't even have one full share yet because again, I'm buying in fractional pieces. My total cost is $132.03. So that's how much I've put into it. And my average share dollar is $150.19. And if you currently look, the market is trading at $135.98, which means that every single time I'm buying more into this company, I'm actually going to be lowering my average share price, which is going to help over time because I'm getting more value, knowing that over time, these companies are going to go back to their 52-week highs and then further past that as well. So for me, buying into these even during the downturns in the market is actually better than buying when the market is going up constantly. So what we're gonna do is look into my activities, and I'm gonna show you guys, like this is literally all of my activities that I'm doing here. Now, before we continue on, if you are getting some value out of this video so far, do me a solid and hit that like button down below. Helps out the channel to continue to grow. And also too, if you are somebody who's a fan of M1 Finance or investing in general and wants to be part of a financial group, I have an M1 Finance group on Facebook. You're welcome to join. I'll have a link in the show notes down below. On there, we actually talk on a regular basis about investments, what we're doing, kind of a little bit more one-on-one. So if you want to have some conversations with me and other people, check out that link in the description down below. Now, with that being said, let's go ahead and hop back on to the rest of this content. And what I'm going to do is go into just my deposits. So you can see that I am not just talking about it, I'm actually doing this stuff as well, because it's one thing for somebody to tell you something that they're doing and actually doing what they're saying. Now, one thing to really keep in mind too, especially around downturns in the market, you have to always realize that one, I am not your personal investing advisor, neither is anybody else unless they are actually a CPA and you are paying them for it. So keep that in mind when watching either myself or any other content creator, or even listening to any other content creator. Make sure you're doing extra research to understand what are your risk tolerance when it comes to investing in the market. Because if I scroll down here, you're gonna be able to see in early January, I was putting about $30 to $40. February, I was putting about $40. That's what I was doing on a typical weekly basis. So I had a little bit of money going in every single week. Wasn't obviously the most in the world because I was just kind of getting my feet back into investing overall. I actually started off with $10 a week back in July, I believe it was, of 2019. And then slowly over time, I just started to bump up the amount that I was investing. And so all of a sudden, when the markets started going down, you know, again, this, whether it's now or 5 years from now when this video has come out, anytime there's a downturn in the market, I look at the opportunity of saying, can I get more for my money now, so that way when it goes back, I essentially gain a lot more than if I was just kind of holding back or maybe not even investing at all. So you can see here, February 26th, I put an extra $50. So it was 2 days after my typical weekly investment. And then a couple days later, I actually also invested in another $140. Then I did my weekly $40. Then bam, I did another $300 just a few days later. And then again, $150, another 100, another 110, and then $30 here. So I did quite a bit more investing than I typically did because I wanted that money to really have a bigger impact, knowing that the market can be down as of right now with this recording, almost 28%. So I'm trying to get more value for my shares that I already have because I can buy them at a lower cost than what I originally got into those shares for. Now, it can be scary, it can be really, frightening to want to put more money in while the market's going down, because like I talked about earlier, we don't know when the bottom is, and not knowing when the bottom is can be really scary because one of the days, I think it was when I was putting in the $300, that very same day, by the close of the day, I think I lost in my overall portfolio $150 in value. So I put in $300 and like half of it essentially just disappeared, which is pretty crazy to think about. But the actual number of shares that I owned overall was still there, and obviously went up because I put in money in the market for that day. But the thing is, if the market starts recovering and going up, people lose out that opportunity. They say that it's always better to be in the market than to time the market. So like I mentioned, I've been investing on a regular basis, but now because the market has been dropping pretty significantly, it was a good time for me to personally start investing more of my money because I wanted more value that I couldn't have gotten otherwise because the market was consistently going up over time. For me, I like the idea of being able to double, sometimes even triple down on what I was already investing in, so that way I can get more of my value in these stocks that I already believe in and believe will come back once the market fully recovers. Because the markets always recover if you look at history, not saying individual companies, but the overall market does. And I always tell people too, if the market doesn't recover, we got a couple other big problems that we have to worry about other than money at that point too. So because I believe in the US economy, I know that these companies are going to overall as a whole come back and potentially even go bigger than they were before, which even if they only get to where they were in their highs, buying at the lower points now means I'm getting more value over time. So I want to show you what I mean from earlier when I said that I am buying more into these funds, even though they're going down consistently. So that recent fund that I deposited, I actually am going to go here and look at my Vanguard Fund. Another $31.91 went into the fund, which bought me about 15% of one share. And I bought the share at $209.77 a share, which lowered my dollar cost average, which is really good. But I was able to buy more into this because I believe that this will come back to its high. If I actually go in here and show you what the high point was, see if I can see the 52-week high. So I think the high point was around $310 or $311. So I'm buying it at almost $100 less than where it was. Granted, I'm buying in fractional shares, but still I'm getting more value for that $31 than if I bought that $31 all the way back in February of 2020. So there's a little bit of a thought process there for me where I'm saying, hey, if I was already planning on buying on a weekly basis into this fund, even at its highest points, I'm more definitely wanting to buy into this fund at its lower points because I want the fund to obviously grow back into where it was at the high point. So this fund right now is down 23%. And so if the market recovers after, today's date and it starts growing back, I mean, that's 23% of my money growing for getting back just to where the 52-week high was, which is really cool. That's how I personally see it. Obviously, everyone sees things a little bit differently. So always, consider that when you're going through the process of investing your money. It's exciting times for some people and it can be scary times for others, but always make sure that you are not trying to make decisions based off of your emotion, because that can be really tough, whether it is putting a lot more into the market when maybe that's not the best idea for you, or pulling your money out of the market, which could also possibly be not a good idea for you. So make sure that you make your decisions rationally and not emotionally when it comes to the market, because either way can really have a huge impact on you, whether it's because you're excited or because you're nervous. So make sure you do your due diligence on that part, and I believe you'll be more secure for the long term doing it that way. Now, if you want to keep on learning more about the stock market, check out my video right over here. Thank you so much for watching, and I will see you in that next video.